Here's a fun thought exercise. Let's say you can only buy one ETF, and after you buy that ETF, the market closes for 20 years. Which ETF would you buy? And really, this is a question of what you want exposure to, and as we always say, start at the asset class level. These are examples of asset classes. So you have, of course, cash, that's the most liquid. You have fixed income, that's what it says on the tin. It's an income stream that's fixed. You have real estate, so that could also be the house that you own. You have ownership of business, so equities or stocks. And you have commodities. Those would be considered an alternative asset class. So the way that a financial advisor will typically approach asset class allocation is to do something quite simple. They'll use this rule called 100 minus your age. So if you're 25, then 100 minus 25, that's 75. So 75% of your assets should be in stocks, 25% in bonds. Then as you age, you see the weighting towards bonds grow. So if you're 50, then half your assets in stocks, half in bonds. If you're 75, then you have 75% of your assets in bonds. Why? This is basically to configure your portfolio so it provides income as you age. And we're going to talk about that. But let's answer this question here. Is there an ETF that offers such a return profile that would emulate the most common advice that you would get from investment advisors? Well, this is where we need to distinguish between funds versus ETFs. So traditional funds, or what they call mutual funds, there's quite a few of those, somewhere around 138,000 in 2022. And we may look at mutual funds in the future. Today we want to focus exclusively on ETFs, exchange-traded funds. These offer liquidity, there's no minimums, and they have, generally speaking, lower fees. Now, plenty of mutual funds out there offer that sliding asset class allocation I just described based on your age. These are often seen in 401k plans, and usually the fees are ridiculous. So just on a side note, you ought to go look at your 401k fees ASAP and make sure the funds that you've allocated your investments to for that plan are have some of the lowest expense ratios of the available menu. So let's talk about income, because that's an important component of that 100 minus your age rule, right? So what's income? Is it a bond coupon? Is it a stock dividend? Is it what the black box magicians over at JP Morgan decide to pay you every month for holding JEPI? Is it Social Security? Is it selling some overweight positions in your portfolio? It's all of the above. This is a very important distinction. So income is simply taking some of your wealth and deciding to spend it on living. You don't need bonds or JEPI or even dividends to generate an income. You can just sell some assets. This is why it's very important to think about this notion of total return when you're invested in an asset. So when we look at stocks and bonds and cash, this is from Ben Carlson, and it shows since 1928 to 2023, a nice diagram of the return that you've seen with stocks versus bonds. First thing to notice, stocks are much more volatile. You see how low they can go, right? But stocks have returned a lot more than bonds. So let's back out inflation at 3.3%. This brings us to that often quoted number we talk about, 6.6%. That's what the market has returned since inception. For bonds, that's what, 1.3%. So you've barely managed to get ahead of inflation there. So if you had to choose one asset class to invest in, it would be stocks based on total return. And the approach that you can then take there is to use what they call the 4% rule. And we've taken MSCI ACWI IMI, so that's All Country World Index and the entire investable universe. What this means is all countries in the world, all caps. All right, maybe not micro cap. MSCI cuts that off at a certain point. They have market cap cutoffs. We've taken that ETF, and then we've looked at $1 million investment to start, and we've taken 4% of that $1 million every year, and we've done this over a period of what looks like about 15 years. Now, this is that notion of selling a small percentage of your assets and living on the money. So they say that if you only sell 4% of your assets every year, you shouldn't run out of money before you die. And that's because on average, the market has returned 6.6% over time after inflation. So we chose this time frame rather arbitrarily, but also because it includes some sizable dips. So the first thing to note here is that over the 15 years, your income would have grown just 1.6%. So that means inflation would be eroding your quality of life. So imagine when you look at this chart here that this is your salary. So you can see that you wouldn't be very happy. Well, initially you would be starting out, you were getting increases every year. And then suddenly, look, your salary dips 19%. The next year it dips 19%. The next year it dips 21%. Boy, you would be hurting then. Now, when you're looking at these numbers, a very American approach to take is to say, well, what can I get away with spending on this salary that I'm paying myself with my 4% rule? Whilst perhaps the Chinese approach would be to say, what am I spending? And then withdraw based on that. So this is assuming that fixed 4%. The key takeaway here is that you need to manage your living expenses for the volatility that this sort of an income strategy would provide. Whilst a strategy such as Quantigence we developed here at Nanalyze, that increases your payments every year. So this is just a steady chart going upwards. So that's the advantages of a dividend growth strategy. But we're trying to pick one ETF. So what do we know so far? A 100 minus your age approach won't work because there aren't ETFs that offer that sliding asset class allocation. There are single funds that do this, but they cost roughly an arm and a leg. Now, stocks are the most appealing asset class in the ETF world, and we want to make sure we have exposure to all factors: momentum, value, growth, size. We don't want to exhibit domestic bias, so the ETF shouldn't be USA only. So let's think about stocks holistically for a second. Now, before we do that, I wanted to touch on what we do here at Nanalyze, which is to teach people how to become better investors. That's our mandate. How do you do that? Well, you teach them the basics of risk management. More importantly, you empower people to make decisions with confidence and conviction. You help them create their own simple, timeless strategies, and you lead by example. That's what we do. If you want to learn more about what we do, sign up to our newsletter, free newsletter in the comment section, and support our work. Thank you. So, going back to looking at stocks holistically, here's a picture of the world, and each square is worth $100 billion. This is Visual Capitalist. They produce some great stuff. You see the New York Stock Exchange and NASDAQ, they're dominating about 45% of the world's liquidity there. The total value of all stock exchanges, 45% belongs to those two exchanges. Then you go down the list: Japan, Shanghai, Hong Kong, Euronext, etc. So when you're thinking about investing in stocks, you can't just think about the United States of America. You need to think about the world. Not doing that is called domestic bias. And here you can see this is MSCI's breakdown of the world. You have developed markets, so those are more overweight because they're developed. Then you have emerging. There's also frontier. Some interesting names on here that Iceland should be in frontier. That's probably the problems they had in their banking system. I worked at MSCI for a decade. We were always challenged about Korea and Taiwan being emerging markets. That's because of the giant panda and the DPRK. Those are the reasons for those classifications. So when we invest in equities, we want to make sure that we invest in all equities, and MSCI's ACWI IMI, that covers 99% of the global equities market, and the United States is around 59% of that. And then you see the breakdown there. So what is our goal? It's to find a global stocks ETF. We don't want to overweight or underweight the United States. We want to diversify. It must have low fees. Those are the most important predictor of outperformance. High assets under management. So if it has a lot of assets, then that helps the fund managers keep fees low, possibly even lower them. And when we try to find such an ETF, Verify, that's a database we regularly use, doesn't lend itself to this exercise. So when we sort on the largest ETFs and go down the list trying to find our international stock ETF, you see that lots of the names here aren't going to work. So you have USA only, and you can read down this list. Watch out for international ETFs that exclude USA. You're going to see a number of those as you go down trying to find the largest international stock ETF. Tickers like VXUS, SCHF, IXUS. What you'll eventually arrive at is the Vanguard Total World Stock ETF. This is what we want. So the ticker's VT. It has $36 billion in assets, and it covers FTSE's description of the entire universe of stocks around the world. An interesting note here is this also exists as a fund. And you see there that investment minimum, $3,000. That's how you can tell it's a fund. But look at the expense ratio is a fair amount higher. And this has $48 billion in assets. It's likely that this fund is found in many 401ks probably. It's not a bad fund. It's just a better alternative to invest in the ETF instead. Now, another alternative to VT would be the iShares MSCI ACWI ETF. So that's MSCI's picture of the entire globe. And right away we see an expense ratio of 32 basis points is just far too high. Even though it has $18 billion in assets, we would always opt for the cheaper ETF. And here you can see the difference between the iShares All Country World Index ETF and the equivalent from Vanguard VT and their holdings based on FTSE. The differences here are going to stem from the different methodologies used by the respective index providers, so FTSE and MSCI. So when people watch this presentation, they're going to be tempted to throw up ETF names that they think are the best ETF. They'll say SCHD. We happen to really like SCHD. It's just that they overweight the USA. It's all USA. And they overweight value. VOO, that overweights USA in large cap. VTI, that overweights the USA. It's the entire collection of USA stocks. QQQ, that's overweighting USA growth in NASDAQ. So the idea here of picking just one ETF is that we do not have the ability to know anything about the future. And remember, the market's closed. We got to hold this for 20 years. We want to be as diversified as possible. Now, what most Americans do is overweight the USA. It's classic domestic bias. Sure, it represents, 58% of the total investment opportunity, but you're missing a fair amount there by only investing in the U.S. So if you can only buy one ETF, it needs to have low fees. These are the most important driver of return. At high AUM leads to lower fees. That's why we want to choose the largest global equities ETF possible. And this idea of an MSCI ACWI IMI type index is the most prudent choice because you've invested in all countries and all caps. You're not trying to overweight or underweight anything. So Vanguard's VT ETF seems like a clear winner here if you could only hold one ETF. Now, I'm going to go ahead and leave you with a presentation we did on SCHD. It's quite interesting. We quite like this ETF, and in this piece we'll tell you why. Please make sure to subscribe to our channel, support our work. Thanks so much for taking the time to watch this today.